Howdy, everybody. Welcome to Liberty Call. Today is, what day is this? Thursday, August 15th, 2024. Hope you're having a fantastical day out there in the interwebs. It's a beautiful day here in Colorado. Not too hot, not too cool. And I've spent a good portion of my day when not paying attention to the markets and what's going on, sanding shelves, which is a lot of fun. So I wore a white shirt today, but now I'm staining them. So now I'm probably going to get, and the gloves I was wearing to stain ripped through. And then so my fingernails are a nice light brown color. So anyways, hope you're having a good day out there. Markets were in a pretty good mood again today. We've got some data to go through, retail sales, production, things like that. So it looks like those reports were in pretty good order. And if it is your first time watching the Liberty Call, if you in the brown shirt could do me a favor, give me some thumbs up, a like, share, subscribe, and follow, and press the notification bell. All righty, let's get into today's numbers. Dow Jones was up 1.39%, 555 points, closed at 4563. S&P 500 up 1.62%, 88 points, closed at 5543. NASDAQ up 2.32%. Real happy mood there at tech. Closed at 399 points, closed at 17,591. The VIX down 6.24%. It's at 1518. Canada was up 1.2, Brazil was up 0.65, and Mexico up 0.96. So good day across the Americas. Headed to Europe, Germany was up 1 2/3, the UK up 0.8, France up 1.23, Netherlands up 1 3/4, Spain up 1.23 also. Italy up 1% flat, Switzerland up 0.8, and Portugal up 0.23. Russian exchange is mixed again today. The MOX down 1.21%, RTSI up 0.13. And the overnights, the Nikkei in Japan was up 0.75%. Australia up 0.19, New Zealand up 1.42. In China, the Shanghai was up 0.94, the Shenzhen Component up 0.71, China A50 up 1.1%, DJ Shanghai up 0.98, Hang Seng down 0.02, and the Taiwan weighted when it closed on the 14th was up 1.06. All right, so those are the markets. Feel smarter? I know I do. All righty, let's get over to the market recap. U.S. stocks jump as stronger economic data dispels recession jitters. So if we're not heading towards a recession, that means we don't need to lower interest rates, right, folks? Again, we're getting conflicting stories from the people in, Washington, the financial journalists, the idiots on the business channels. If everything's good, why do we got lower rates? Seriously. Come on. We know that's not the truth. They're smoothing over the data to make it look good. So we know that. All right, U.S. stocks surged on Thursday, fueled by stronger than expected retail sales and labor market data, which eased fears of an economic slowdown. Retail sales in July exceeded expectations, rising by 1%, which was significantly higher than the anticipated 0.4% increase. This marked an acceleration from June's unchanged reading and suggested that consumer spending remains robust, allaying concerns about an imminent recession in the U.S. economy. On an annual basis, retail sales climbed by 2.7%, up from a revised 2.0 in June. So again, pay attention to the consumer spending. That's probably the one thing that is going to tip over first when the economy really starts to accelerate its slowdown. So that's what I would look at. You can just pay attention to the idiots on TV if you want. So the positive retail sales report underscored the resilience of the American consumer and sentiment echoed by analysts at Stifel. Additionally, the labor market showed signs of strength with a decline in the number of Americans filing new unemployment claims, indicating that the labor market remains relatively stable. These economic indicators, coupled with the softer than expected consumer price index and producer price index readings earlier in the week, have raised expectations for a potential interest rate cut by the Federal Reserve in September. Again, if the economy is fine, why are we going to lower rates? Because, if things are still trending in an upward trend, you would continue that until it stops. And then you would crank rates back maybe by a 1/4 or 0.5%, because then you would have found your neutral position. So all we're doing now is just monkeying with the system and going to make it worse. Personally, I'd leave interest rates up to the banks. They're the ones who have, they don't really take risk anymore. They lend out fake dollars. And when they do it too much, they get bailed out by us, the taxpayer. So what am I saying? All right, let's jump back into the article. In the corporate sector, Walmart stock rose nearly 7% after the retail giant reported second quarter earnings that exceeded expectations, driven by strong e-commerce growth and improved profit margins. Cisco Systems also saw a 7% gain after posting better than expected earnings and announced a restructuring plan. Meanwhile, Tapestry's stock increased by more than 4% following a positive quarterly result. Notably, Ulta Beauty's stock jumped 12% after Warren Buffett's Berkshire Hathaway disclosed a new stake in the cosmetics company, boosting investor confidence. Additionally, Nike's stock gains 5% after Bill Ackman's Pershing Square revealed a position in the sports footwear retailer. Overall, the day's robust data and corporate earnings reports helped dispel fears of an economic downturn, driving significant gains across the stock market. So again, I'm not saying things are, going to just collapse immediately, but things, again, if you watch this on a daily basis, I cover enough of these reports, from my friends over at First Trust who really dig into the details. There's a lot of areas of the economy that have been in contraction mode for a long time. All right, first up, July retail sales from First Trust. Nate Guerzi, economic analyst, put this one together. Let's see what he had to say. The U.S. consumer showed unexpected strength in July, with retail sales rising 1%. However, the headline figure is somewhat misleading. Much of this increase was driven by a 3.6% jump in auto sales, rebounding from technology-related issues that had depressed June's numbers. Excluding autos, retail sales still rose a solid 0.4%, beating the expected 0.1% increase. The gains were broad-based, with 10 out of 13 major categories seeing increases, including grocery stores, 1%, general merchandise, 0.5%, building materials, 0.9%. However, sales at miscellaneous store retailers fell by 2.5%. Core sales, which exclude volatile categories like autos, gas, and building materials, rose by 0.3% in July. This suggests that core sales could be at an annualized rate of 3.8% in the third quarter if they remain unchanged in August or September. Notably, Amazon Prime Day had less of an impact than last year, with non-store retailers up only 0.2% compared to 2.2% in July of last year. Restaurant and bar sales increased by 0.3% in July, but have been slowing, rising at an annualized rate of only 1.9% and 2.1% over the last 3 and 6 months, respectively. Over the past year, overall retail sales are up 2.7%, but inflation-adjusted real retail sales have declined by 0.3% and have been stagnant for 3 years. This data aligns with the view that the U.S. economy is slowing, partly due to lagging effects of a decline in the money supply, M2, from early 22 to late 23. Additionally, initial jobless claims fell by 7,000 to 227,000, while continuing claims also dropped by 7,000 to 1.864 million. Import prices increased by 0.1% in July, with export prices up by 0.7%. All right. So good stuff there. The jobs numbers still look good. I mean, they're slowing in some areas and strength in others. So just the way it is. All right. Next up, July industrial production and capacity utilization, also from First Trust. This was put together by Bryce Gill, economist. Alrighty. In July, U.S. industrial production fell by 1.1%, a larger decline than expected, partly due to revisions of previous month's data. The Federal Reserve noted that temporary shutdowns caused by Hurricane Beryl contributed to half of this decline. Manufacturing experienced the most significant drop, with a 0.3% decrease driven entirely by a 7.8% decline in the volatile auto sector. However, non-auto manufacturing, considered a core measure of industrial production, saw a 0.3% rise, bolstered by a 1% rise in high-tech equipment production, likely due to investments in AI and reshoring of semiconductor production. Other manufacturing sectors, such as chemicals, petroleum products, and textiles, have also been performing well, with non-durable manufacturing growing at a 7.5% annual rate over the past 3 months. The utility sector declined by 3.6% in July as demand for air conditioning normalized after months of higher than expected temperatures. Yeah, it's kind of cooled off here. I haven't had to open the windows up on the main floor really until like 5 or 6 in the afternoon. And that's, really not too hot just to have some breeze coming through. So, don't have air conditioning, so there's no wind in the house, so it can get a bit stagnant at times. So, but yeah, it is starting to notice a cooling effect. I guess that's because the sun is setting sooner in the day. So, all right, where was I? The mining sector remained flat, with gains in oil and gas production offset by a slowdown in drilling and mineral extraction. Additionally, the Philadelphia Fed Index, which measures Factory sentiment in that region fell sharply to a -7 in August from a +13.9 in July, while the Empire State Index, its New York counterpart, slightly improved to -4.7 from -6.6 in July. So, all right. So again, like I said, it's kind of a mixed bag. Some things are still okay. Some things are worse. Unemployment still seems really good. Going back to the previous report, going over the unemployment numbers. So, like I said, I wouldn't dwell too much on the unemployment. Maybe pay attention to the amount of layoffs. I know Challenger Gray and Christmas is a company that follows the layoff numbers pretty regularly, so that's something to pay attention to. But again, I would pay attention to spending, because people will, when things get too tight, will reduce what they spend because they start hoarding their cash. And, that's where we'll probably see it first. So again, I could be wrong. I mean, it could be something else. I mean, we could have some sort of other crazy thing, black swan type event that occurs that I'm just not thinking about. But based on, the trend we're in right now, that's what I would put it at. The Fed may lower rates just to, shut everybody up, next month. But I don't think they're going to do any significant rate cuts, like what we had the last decade and a half, until something terrible happens, which I expect, simply because the last time we had the downturn in the spring of 2020, we poured all this money on the problem and it just disappeared. I mean, markets went up almost immediately, and but we have to deal with the inflation from that. So, when they did it back in 2008 and 9, they did not create all the cash. They bailed out a lot of companies, but they didn't create all that cash and dump it into the system. So the inflation wasn't nearly as bad. I mean, we still had, the money supply continued to increase, 2 to 3% a year, but we did not feel, it wasn't like this big shock that just punched you in the nuts. All right, one last article here. This one comes from Zero Hedge. More questions than answers by, this was written by Jane Foley, a senior FX strategist at Rabobank. So, all right, the latest economic developments indicate a mixed global outlook with varying impacts on central bank policies across key economies. In the U.S., the July CPI inflation report suggests a possible Federal Reserve cut in September, although there remains debate over whether the Fed will opt for a 25 basis point cut or a more aggressive 0.5% cut. The moderation in core CPI inflation to 3.2% year over year reflects a disinflationary trend, but rising home prices pose a challenge. Market focus now shifts to upcoming retail sales data for further clues on consumer resilience and the Fed's next move. Japan's economy received a boost with better than expected Q2 GDP growth at 3.1% annualized, driven by a strong private consumption and business spending. This supports the Bank of Japan's recent hawkish stance, though market volatility suggests caution in future policy changes. In the UK, Q2 GDP growth met expectations at 0.6% quarterly, but was driven largely by government spending rather than consumer strength. And we know what government spending is. It is not production. It is theft, in my opinion. The Bank of England is expected to make one more rate cut this year as inflation remains high despite recent easing in services inflation. Why are they cutting rates if inflation is still high? That's a good question. Let's see. And then Australia's labor market showed robust employment growth in July, though the employment rate ticked up to 4.2%. The mixed data aligns with the Reserve Bank of Australia's expectations, likely leading to a pause in rate hikes until May of next year, 2025. However, falling iron ore prices and concerns over China's steel production are weighing on the Australian dollar. Overall, central banks in the U.S., Japan, and UK and Australia are navigating complex economic conditions, balancing inflation concerns with the need to support growth. So basically, we've got all these reports, and we have no more clear direction today than we had, say, at Christmas of last year. So. All right. Well, that's everything that I had for today. If anyone needs anything from me, please go to DSAFinancialGroup.com. Yeah, you can go there and get all your financial needs met, financial planning for retirement, whatever you need. Give me a buzz. I'd be happy to help. All right. Well, I hope everyone has a wonderful evening out there. I'm going to head back out and apply some more stain. And then tomorrow I'm going to do poly. Yes. And then hopefully by the weekend, my shelves will be back up and my wife will be very happy because she'll get all the crap off the dining table that's been there for a few weeks. So, all right. Well, I hope everyone has a wonderful evening, and I shall talk to all y'all again next time. Adios.